Oh, yowzers. Netflix down 10% after hours. Another one we were anticipating this week as far as earnings reports were concerned. So, what in the world is going on that this thing dropped? Well, 10%. One factor I need to mention that likely contributed is the fact that this stock is actually up 60% this year already. I am going to throw that one out there already. Just because you got to throw that out there, right? The stock has shown incredible movement this year. So, and the fact that the whole market is relatively flat, all things considered, see the stock rise 60%, again, you may think there's got to be a good reason for it. So, again, that's part of why it dipped. But let's look at these earnings and see exactly what may have been the cause. So, overall, you see from an EPS perspective, they missed by 22 cents, $1.59. It is good to see profitability with this company, and they're growing profitability pretty quickly. Overall, though, if you look at this, it only raises that PE ratio even higher. Right? We're already talking about a PE ratio over 100 at this point. So with that, obviously you get concerned with valuation, but again, it's a growing stock because you look down at the revenue and you see a 25% increase year over year. I would relatively call that flat. Beat by 70 million, I would call flat. 6.15 billion in terms of that. I did expect a little bit of a beat in terms of revenue, so not unexpected there. You talk about really just this is the perfect environment for a company like Netflix to thrive in. More watch time than ever, really. More time spent on the internet than ever for everyone. So definitely a good time for them to thrive. They added 10.09 million customers versus a consensus of 7.5 million. So massive beat on that aspect, which is really good to see. I did anticipate a beat on customers as well. I expected an increase in net adds while they were a little bit light, but again, I mean, I don't know why the analysts, I guess because they've got the money, they've got money, they don't care about anything. Their life has been normal. Everyone else that's been locked down hasn't been able to go to work, right? They have nothing to do, so they turn to streaming. No movies, nothing. They couldn't do anything, so they had to turn to streaming platforms, and Netflix gained because of that. For quarter three guidance, they're expecting 195.4 million, which means they want to add approximately 2.5 million in the next quarter. Not that many, all things considered. So that's likely going to be the issue for this downward move. Only adding 2.5 million in this next quarter it's still pretty big when you talk about the fact that they're up 23% year over year in terms of subscribers. But you also talk about the fact that it's only 2 million up. 2.5 million growth seems light, especially still that we're in times of, pandemic concerns. So, with that considered, let's look at some of these fine details. So, Netflix down 12%. B-Rest moves yet fell below lofty profit consensus. The company had 10.1 million global streaming subscribers. Love that. Sell-side analyst consensus hasn't been much higher, and the company blew out expectations. There was nearly 15.8 million ads in Q1. Okay, so overall, things look pretty good for the company, right? So the new result is somewhat in line with informal whisper numbers, taking into account ongoing pandemic measures. Duh. So the company guided quite low numbers, just 2.5 net ads, and they were expected to do at least 5 million. So definitely a big miss in terms of guidance, but again, they were over by 2.5 million compared to their guidance this quarter. So take that with a grain of salt. What'd you like to say? If you talk about that, then really they added 5 million next quarter, right? I'm just saying. Maybe I'm insane, but to me that adds up. So revenues were 25%, topping the consensus. Good to know on that aspect as well. Operating income was 1.36 billion, with a margin of 22.1, which was up from a year ago. So they doubled operating income year over year. Big stuff. Net income jumped $720 million from a year ago's $271 million. So that you saw a 3 times increase actually. So shoot, short of the expectations of $1.83, but that is a massive, massive growth in net income year over year. You gotta say it. You gotta admit that. Come on now. As much as I've kind of been a hater of Netflix for the valuation, this is a company that is starting to earn the valuation. It's starting to do it. It's starting to get there, I will say. The company's also named content honcho Ted Sarandos co-CEO along with Reed Hastings, and elected him to the board of directors, and Chief Product Officer Greg Peters is added to the Chief Operating Officer role, or COO. Let's look at these earnings slides and take a look. Obviously, you see from year-over-year growth this entire year, they've seen overall, this isn't giving me a full year, but 24 or nearly 25% growth this quarter. Last quarter, 27.6% growth. Quarter 3 expected 20.6%, which is obviously a decline in terms of overall revenue year-over-year growth, but at some point you have to slow down. You can't just be an infinite growth beast forever. You can't always be growing 20% because at some point that just becomes unsustainable. You think a company like Walmart, who is doing $400 billion, can grow 20%, you're smoking something. I'm just going to be honest. You're saying they can grow $80 billion in a year? It's just not possible. So, overall, though, net income, look at this net income growth. You see pretty much good growth here from Q2 2019 to where it's at right now. Even with pandemic environment, pretty good. EPS has shown growth. Forecast is even higher than that. That's good. This quarter 3 forecast is good as far as this net income line is concerned. So, pretty nice. And overall, subscriber growth has been really good. Really good. This quarter was really good. 2.5 is one of the, it really is the lowest in the last year as far as net additions is concerned. So there is that. But then again, additions is better than subtractions by all aspects. Forecasts, as we saw, nothing major here. We look at the chart. Naturally, red line being this year's, and obviously we saw massive growth in, what a shocker, March and April, because of the fact that everyone's locked down and they had nothing to do, and I mentioned that. But now they're expected to flatten out and not really show as much growth, where previous years it was just a consistent growth throughout the year. This year is going to be very weird, where you're probably going to see some just flat for the rest of the year for the most part, probably. So they really talk about content and how they plan on delivering more content. Obviously, the concern here comes with filming, everything like that, but this is just a mention of all the upcoming content to look at. Competition, naturally they mention Peacock, they mention Disney Plus, HBO Max, everything going on. There's a lot of competition for them. But again, my consensus at the end of the day is there's not just going to be one dominant streaming performer in the world. That's not how it works. Overall, it is a lot cheaper to have 3-4 streaming services than it is to have cable for most people. So that's likely what they're going to do. So Netflix just has to be one of those 4 that people choose. And with the way they do that is by having just a massive library of content, and that's what they're doing right now. Now, obviously, that increases expenses, but the way they're doing it is pretty massive. They want to grow these people, grow paid subscribers. That's how you do it. So pretty exciting. We also on here by region. They do give a region, United States and Canada here. Good growth as far as that's concerned. Year-over-year growth of 6% this quarter, lower just a little bit. Average revenue per user, you see that at $13 range. In Europe, not as much growth there naturally, not as much growth in Europe, Middle East and Africa, Latin America, not as much growth there either. Actually, some negative year-over-year growth in Latin America as far as average revenue per user, in Asia, Pacific and China, Australia, Sorry, you can't forget Australia. I'm sorry. Australia, Asia Pacific, China, Asia Pacific, Australia, China. Look at me. I can't speak. But, anyways, they saw a 4% decline year over year in average revenue per user. You don't like to see it, but again, U.S., there is some growth there, but you want to see some more of that. Then we get into the balance sheet naturally with this company, which I think is one that needs to be talked about, right? Total current assets of $8.5 billion versus $6.1 billion of 6 months ago, so good growth there. And again, I mentioned with every company, they are all doing this. They're raising capital right now to make sure they can survive pandemic environments, so you see them taking on a lot more long-term debt. Total assets in general, $37.1 billion versus $34 billion of 6 months ago, so $3 billion in growth there, really. From a total current liability, you see 7.6 versus 6.8 billion. Overall, they grew assets more than they grew current liabilities, which is good. And as far as total liabilities is concerned, 27.8 versus 26.4. You see good growth on that aspect too. Good growth as in it's not growing as fast. $1.5 billion added versus the total assets added of around $3 billion. A little over $3 billion. So good to see them really double their assets that they added compared to liabilities. So that is good. Total stockholder equity of $9.3 billion. This was a company I originally was concerned about as far as valuation because of the lack of profitability, and they've really turned it around. Now I don't think this is necessarily one I would consider a stock to buy, even at this price drop 10% down to 400. I like this stock a lot more under 400, if I got to be honest with you. I don't like it at these levels for many reasons. 52-week highs of $575 is really expensive for this company right now, especially when you look at the fact that they could eventually, they're due to find slowing growth. And what do investors do when they find slowing growth out of a growth company? They abandon ship. So that's my concern with this company, and I think that slowing growth will likely be next year. You'll probably start to see that. So I have a bad feeling about the stock next year. Not to say it won't outperform the market. There's no saying that at all. So far, it has really much, very much outperformed the market this year. I just know investors can be irrational, and the second they see a sign they don't like, even if the company's still growing, they're still going to be freaking out and going bye-bye. But I hope I'm entirely wrong on that, and if you're a Netflix investor, I wish you luck. The company's turned things around quite a bit. It's good to see profitability, but valuation's still a little too sketchy for me. Hope you enjoyed.